The government says inflation is cooling off, dropping to 3.5% a year. But when you pull up to the pump and see gas at over $6 a gallon, that official number doesn't match your reality. If the worst of the economic crisis is supposedly in the rearview mirror, everyday expenses should be offering some relief by now, yet they aren't. The confusion comes down to how we talk about prices. We are mixing up the speed at which prices are rising with the actual total amount we pay at the register. What we are experiencing right now is disinflation. Think of it like taking your foot off the gas pedal. The car is still moving forward, just at a lower speed. We expect prices to go into reverse, but they are still creeping up. So lower inflation doesn't actually mean life is getting cheaper. It simply means the cost of living is pushing us into a hole at a slower pace than it was last year. This chart shows the exact mathematical trap consumers are caught in. Imagine a typical grocery trip cost $100 a few years ago. After a period of intense inflation, that line climbs a steep curve, and those exact same groceries now cost $120. When you read a headline that inflation has fallen dramatically, it only affects the trajectory from this point onward. The line flattens out, but it stays locked at that $120 mark. It doesn't undo the climb. Economists call this the price ratchet. It's a mechanical reality where prices easily move upward during a supply shock or crisis, but once the dust settles, a latch drops and locks those higher prices in place. Almost everything we buy has passed through this one-way valve. What used to be a temporary spike has crystallized into a permanent floor for the cost of living. The financial stress millions of families feel right now isn't because grocery bills are currently rocketing higher. It's because we are all stuck at the top of that ratchet, trying to survive on last year's budget. To understand why prices won't drop, we have to look under the hood of the physical economy and see exactly what is holding that ratchet up. The strongest upward pressure comes from the housing market. We have severe structural shortages in property. Home builders haven't completed enough units to meet demand, keeping rent and mortgages artificially high and cementing a massive portion of the new baseline. Because homes and vehicles are now worth more on paper, the cost to insure them is mathematically tied to that higher value, keeping monthly insurance premiums permanently elevated. In the corporate sector, companies spent the last few years overhauling their logistics networks to survive global disruptions. Those rebuilt supply chains are more resilient, but they are also more expensive to operate, and that extra cost is now baked into their daily operations. Then there are the literal stacks of international goods waiting at the ports. Many of these imports carry heavy new tariffs, and companies are quietly passing those border taxes directly on to the final price tag at the store. Even though the initial shock of the pandemic is over, this tightly wound web of housing shortages, expensive logistics, and import taxes ensures the math simply won't allow prices to drop back to where they were in 2019. Just as those logistics and supply chain headaches finally started to settle down, a massive new force entered the economy, one that threatens to pull the price ratchet up another notch. We are rapidly building the AI economy, and artificial intelligence requires an unprecedented scale of physical infrastructure to function. These new AI data centers are immense. They are filling vast warehouses with dense rows of servers, drawing staggering amounts of electricity and putting enormous strain on local power grids. Powering those servers requires highly specialized computer chips. The race to dominate this technology has created intense global competition for silicon, bottlenecking supply lines for everything else that requires a microchip. This multi-billion-dollar investment wave is generating incredible opportunity, but by devouring raw energy and high-end hardware, it's adding a fresh layer of inflationary heat to an already stretched economy. The Federal Reserve is watching all of these interconnected pressures with extreme caution. They have kept interest rates frozen because they are stuck in a dilemma. If they declare victory over inflation and lower rates too early, cheap money could flood the market and cause the price ratchet to click forward once again. The direct result of this caution is that the cost to borrow money, whether for a 30-year mortgage or a used car loan, remains punishingly high, and will stay there until the data definitively proves prices have stabilized. The very institution designed to manage the economy is effectively paralyzed, forced to maintain heavy borrowing costs to smother any chance of a second inflationary fire. This leaves us with an uncomfortable but necessary truth. The prices we remember from a few years ago are dead, and they are never coming back. The goal of modern economic policy is no longer trying to force the absolute cost of living to go down. That battle is over. Instead, we have to look at purchasing power. The only mathematical way forward is for everything else, specifically worker wages and household incomes, to rise up and meet that new baseline. The true test for American financial relief isn't whether inflation neatly hits a 2% target. It's whether families can finally grow their paychecks enough to survive in a permanently more expensive world.